higher for longer interest rates continue to dampen demand and drive more inventory. As of Monday, June 3rd, the DMAR 11 county area had 9,159 active listings available for sale. To find a larger number for May, you'd have to go back to 2012 when active listings hit 10,591. Of course, numbers mean the most when they're set within a context. In 2006, during the housing bubble, extreme supply outpaced demand. Active listings crushed a record-breaking level of 30,457, juxtaposed to May 2021, when historically low interest rates drove inventory shortages and a buying frenzy. Active listings hit a record low of 2,075 homes for sale. The average number of active listings during the month of May, going all the way back to 1985 to 2024, has consistently been just under 15,000. Now, if I examine only the post-recession time period from 2012 to 2024, that average number of active listings drops to 6,600. If you further limit the comparison to what groups like ICE and Altos deem as normal or pre-pandemic, 2017 to 2019, the DMAR 11 county area averaged 7,074 active listings for sale. Now, fast forward to current data, inventory in the Denver market has not only recovered, but it's bringing buyers 29% more inventory to choose from compared to this pre-pandemic normal. Interestingly, the historical increase of active listings from April to May is around 7.5%. This May, active listings jumped 31% from April, a new record high increase. Andy Walden, vice president with ICE Mortgage Technology, formerly Black Knight, noted in his June 3rd report of April data that inventory seems to be the primary differentiator when it comes to the bifurcation we're seeing in housing market temperatures across the country, with states like Texas and Florida and California driving the bulk of the inventory gains while also experiencing some of the largest price declines. Per Altos research, nationwide inventory is up 39% from last year, yet it's still down 30% from their normal time for this year. Denver Metro, comparatively, is up 75% from last year and up 29% from those same normal years. Yet, while other inventory-saturated markets experienced monthly negative price changes in April, Denver remained positive. ICE measured Denver's April one-month price growth at 0.2%. Looking back, we might ask, was that the peak? Maybe. While it will be another month until appreciation data is available, both DMAR's median and average price growth reversed, with just under 0.5 and 0.75% declines, respectively, during the month of May. New pending sales also slowed from 8% increase in April to just under 2% increase in May. Nationwide, mortgage purchase applications dropped 2% during the month of May, as mortgage interest rates started and ended the month at 7.4%. The only two times since 1995 that mortgage purchase applications were lower occurred when rates climbed back up to 7% in April 2024, following a decline from 8% peak in October 2023. Year-to-date, closed sales are also lagging, lower than any previously reported January through May timeframe since 2012. Although May closings popped 6% from April, overall closings are down just over 5% year over year and down 2% year to date. As long as rates stay higher for longer, demand will be suppressed, inventory will rise, and this will put downward pressure on home prices. So how long will rates stay higher? I mean, the economy is slowing. It's also incredibly resilient. Personal income increased 0.3% month over month, consumer spending was up 0.2%, and retail sales reported earlier this month was flat month over month. While these figures are down compared to the previous month, indicating signs of slowing, they remain strong when compared to last year. And consumers are anxious, but but they're also confident. After 3 straight declines of the confidence index, consumers are feeling good again. Maybe it's May flowers and the summer breeze or the consistent resilience of the American consumer, but the Conference Board's Consumer Confidence Index jumped to 102 in May from an index of 97.5 in April, mostly based on their assessment of current business and labor market conditions. Now, individuals making over $100,000 or under the age of 35 expressed the largest rise in confidence, which might explain why our over 1 million market had the highest increase in pending and closed homes in May. May's tempered inflation report provided hope, but continued progress will get harder. Using the modest monthly increase of 0.2% observed in May, to project inflation for the rest of this year, core PCE inflation could rise from its current 2.8% to 3% by year end. This potential increase is due to the replacement figures from 2023 becoming quite low in the second half of the year. The Federal Reserve has their work cut out for them and require softer inflation data for longer before they consider reducing the Fed rate. Unemployment and job numbers for May might help, especially after April's 3.9% unemployment and lower than expected 175,000 jobs created. There are also expectations that the stock market could see a 10% correction during the third quarter 2024. Now, this would dampen Americans' wealth effect, curtailing spending and soften an already slowing GDP, which has dropped from 3.4% during the fourth quarter 2023 to 1.3% for the first quarter 2024. The second half of 2024 presents more uncertainty. Lawrence Yun was recently quoted as saying he expects a 9% increase in existing home sales from 2023 to 2024, and an additional 13% increase in 2025. Now, his forecast assumes falling long-term interest rates. While I hope to see the lower rates he anticipates, I'm not convinced we're there yet. Considering the Fed's wait-and-see approach through the summer, with only moderate hopes of a rate cut in September, it seems Powell shares my uncertainty. One indisputable fact, however, is Yun's open question. How can home sales be this low when we have so many people living in this country? Despite existing home sales being equivalent to those in 1995, the United States today has 75 million more residents, with the UN projecting our country's continued population growth through the year 2100. Additionally, there are 40 million more Americans working today than in 1995, which begs the question, when rates do come down, what will happen with the excess inventory? Until next time, Nicole Rueth with Movement Mortgage and DMAR's Market Trends Committee. It's my pleasure to keep you updated.